All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. Today, I'm going to stray a little bit from the Double Play theme again. I want to talk about how much money you need to retire. And this is just something that comes up in discussions with people, and I just find that a lot of people don't know how to convert the income that they need in retirement to the amount of savings that they need in order to generate that. So for those of you who are rental investors, your job is kind of easy. I mean, you can just look at your income and decide when you can replace your W-2 job or your salary job. But for other people, saving money, a little bit of money to the 401k every month and so on, those people don't quite know when they have enough or even if they're saving enough. So what I intend to do today is just spend some time talking about how you can use some simple hacks to figure out how much money you need to save to generate a target income. So if that sounds interesting, stick around after the intro and we'll get started. All right, thanks for sticking around. I'm Tomrutkowski with Innovative Retirement Strategies, and this is the Double Play channel. And I created this channel because I know how hard it can be to try and find information on the internet. Either you're seeing 180-degree polar opposite views on something, which for life insurance is not uncommon, or you've got a bunch of people in suits who are just giving you fluffy information, using big words, but there's not a lot of valuable content. And what I intend to do is to answer every single question that you can possibly think of, technical or not, regarding using life insurance to invest in real estate. So before we get started, let me take care of a couple housekeeping items. All of this information is purely educational. There's no advice being offered, no tax advice, no legal advice, no financial advice. And also keep in mind that the primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. If you find this content valuable, please consider supporting this channel. I've got a link to buymeacoff.ee down in the description. And if you'd like to support this channel financially, you can choose to donate. Also, while you're down there, please be sure to give this video a thumbs up. And if you're not already subscribed, please be sure to subscribe to this channel. So, all right, let's get started. So my goal with this presentation is to show you a few simple rules of thumb that can be used to calculate the amount of savings necessary to generate a target income in retirement. So I don't plan on spending a lot of time figuring out how much income you need, because there's a ton of information and content available on that subject. But I am going to give you a few pointers, things that you can use, some resources that you can use to figure out how much income you might need in retirement. Again, the goal of this presentation is to, once you've figured out that income requirement, to turn that into how much money do I need to have in order to generate that income. So the way I want to go about this is we're going to spend a little bit of time talking about retirement income planning. Then I want to show you a couple of little hacks that you can use to figure out how much income that you need. I'm going to show you a couple of little hacks to figure out how much money you need to have in savings in your 401k, your IRA, your brokerage account, cash value life insurance, in order to generate the income that you have specified. So we're going to talk about the 4% rule and the 8% rule. All right, so let's spend a little bit of time talking about retirement income planning. Rather than reinvent the wheel, a few years ago, I wrote a financial checklist for cruisers, and I made that available on my website as a download. And while this is not exactly geared towards retirement, I'm a big sailor myself, and I wrote this to help people who wanted to cast off and live aboard and cruise to the Caribbean or wherever, to show them a way that they can, a framework that they can use to plan on when they can set sail. Set a target date, when you want to retire, determine how much income that you need to support that kind of lifestyle, how long you're going to need to have that income last. In the case of retirement, you more than likely want it to last the rest of your life, but how long will that be? Number 4 there is how much savings do you need? So once you figure out how much income you're going to need in retirement, the next step is to figure out how much savings you need to generate that level of income. And that's what we're going to be focusing on in this presentation. And finally, number 5 is how much must you save annually in order to get there? So once you've got the income figured out, how long you want it to last, how much you're going to need to have in order to sustain that, then you need to figure out how much you need to save annually in order to get there. So the retirement planning process is fairly straightforward, but clearly there's a lot of variables in this. We don't know what the inflation is going to be between now and the time that you retire. We don't know how much things that you need are going to cost. We don't know exactly how much you're going to get in Social Security. So a lot of variables, there's a ton of resources. I just hope that you'll find this little resource, even though it's geared towards cruisers, to be somewhat valuable in assisting you plan for retirement. All right, so now let's talk about the 4% rule. The 4% rule is a rule that financial advisors use to determine the safe withdrawal rate from your retirement savings. And the idea is that you won't outlive your savings by not taking too much. Now, there are some caveats with the 4% rule. By 4%, it already accounts for some market corrections. And what do I mean by that? Historically, the stock market has returned, let's just say 8-9% year over year for the last, 30, 40, 50 years. So you would think that you could take, on $100,000, for example, or $1 million, you would think that you could take, $70,000, $80,000 a year, because the cash is going to keep on growing and live off your interest. But what happens is, like in 2006, for example, the market crashed and it went down almost 40%. So if you started retirement with $1 million in savings prior to the crash, you would have ended up after the crash with that million would have turned into about $600,000. So the 4% rule allows for you to continue taking that safe income that you determined and hopefully not exhausting the cash. Because you can understand that let's just say 4% of $1 million is $40,000. And notwithstanding the taxes, because if you have that money in an IRA or a 401k, it hasn't been taxed yet. So depending on your tax bracket, you may only net $30,000 or give or take. But if the markets went down 40% and you find yourself in the second year of retirement with only $600,000 of assets, that $40,000 represents a much bigger percentage of $600,000. So I'm talking too much about it. Let's skip to the next bullet point and talk about how does it work. So essentially, if the safe withdrawal rate from your savings is 4%, then the savings needed is to flip it. We're flipping the 4% rule around to determine how much you need to save to generate that income. So the 4% rule is your savings times 4% tells you how much income you can safely take. But if your savings needed is the income requirement, if you divide that by 4%, then you'll arrive at the amount of money that you need to have in order to generate that amount of money. So for example, if you need $100,000 a year of income, $100,000 divided by 4% is $2.5 million of savings. So that's how it works. Next, I want to move on to the 8% rule. Now, the 8% rule only applies to cash value life insurance. So you may be wondering, how can life insurance generate twice as much income from the same amount of money? And if you watched the last video that I put up on retirement planning, the reason that a life insurance retirement plan can generate twice as much income from the same amount of savings is that you're not physically withdrawing it like you would from a 401k or an IRA. With a 401k or an IRA, you're taking an actual withdrawal, and the custodian is liquidating some assets and sending you a check for some money. So you no longer have that money in your brokerage account or your 401k or your IRA. However, with life insurance, you're not taking money out, you're not taking a withdrawal, you're using a policy loan, and you're getting that income as a loan against the policy. So just to be clear, that you're not borrowing your own money. In a life insurance retirement plan, the insurance company is loaning you money, their money, with your cash value serving as collateral. So what that means is your cash value is still in the policy, and it's still earning interest or dividends, despite the fact that you have a loan that's outstanding that's accruing interest. So the next bullet point, the 8% rule caveats, we're assuming 1% of interest rate arbitrage in order for that 8% rule to hold true. Now, even if there's no arbitrage, and what I mean by arbitrage is if the cash value of the policy is growing at 5% and you've got a loan at 5%, that's what's called a wash loan. So as the loan accrues interest, the cash value is growing at the same rate and still is fully collateralizing the loan plus the borrowed interest. So at the end of the year, let's just say you borrow $100,000 at 5%. At the end of the year, you're going to owe $5,000. But the same $100,000 that's securing that loan of cash value also grew by $5,000. So the insurance company is literally loaning you $5,000 to pay themselves the interest, and they're tacking onto your loan balance. So you've got $105,000 of cash value securing the $105,000 of loan balance. Plus, if you're taking retirement, you've got lots of other cash value to serve as collateral as well. Now, 1% arbitrage, what this means is, typically, because insurance companies invest for the long term, they can trade liquidity for a higher rate of return. And generally, in the typical yield curve, the further you go out, the higher the interest rate that you need to capture. People are going to tie up their money for a long period of time. They want to know that they're getting a higher rate of return. However, policy loan rates are typically indexed to the Moody's corporate bond yield in some way. So just to give you an example, in today's market, Mass Mutual, whole life company, is still offering a 6% dividend. And mind you, this is March 3rd of 2022. So Mass Mutual is still offering a 6% dividend while they've got a 5% variable loan rate. So there's your 1% arbitrage. And if you look back over 30 years, you can see that 1% arbitrage has always been there. In the case of an indexed universal life, you can, even with today's low cap rates and low interest rates, if you apply today's cap rates to the changes in the index over the last 30 years, you would still come up with a return overall, return on the cash value of about 5.5%, give or take. Depends on whether you look at 5-year periods, 10-year periods, 15, 20, 25, 30. But over 30 years, it would have returned about 5.5%, even with the low cap rates that we have today. Now, if you retire today, policy loan interest rates are down around 3%. So there's 2.5% of interest rate arbitrage. Even though when I run an illustration and I show it to you, I'm only showing about 1/2 of 1% of arbitrage, just to show you, a worst case scenario, to be conservative. So let's talk about how it works. So if the safe loan rate, if you wanted to take income and you had $1 million of cash value, then 1 million times 8% would be $80,000 a year of tax-free income that you could get from your policy. So that's the 8% rule. Now, how do we turn the 8% rule around to determine how much we need for a given income requirement? Well, if we need $100,000 a year of income, for example, just as in the 4% scenario, we're going to divide $100,000 by 8%, and the result is $1,250,000 of savings. So you need half as much savings or cash value to generate the same $100,000 a year as in the other scenario, using a typical retirement assets. All right, so the goal of this presentation has simply been to show you a couple of simple hacks that you can use to determine how much you need to retire. And we use the 4% rule to show you how you would target that with a typical brokerage account or IRA or 401k that's invested in a typical retirement assets. And then I also showed you the 8% rule, which applies to a cash value life insurance policy or a life insurance retirement plan. And then I spent a little bit of time just talking about income planning to give you a framework that you can work with to help plan for how much money you need, how much income you need in retirement. So I kind of covered two bases, but just very briefly on the income planning. And as you hopefully noted, the cash value life insurance is capable of generating far more income from a reduced amount of savings. All right, so if you're hungry for more information and you're not ready to talk to a life insurance agent yet, then I recommend going out to Facebook and joining the Double Play group. This is a group that I created several years ago. It's made up of people who are my clients, people who are my prospective clients, lots of people who discover these videos and are just interested in learning about this, or they actually have policies and they're doing it themselves. But all of my videos and blog posts and everything get posted up there, and it's a place where you can ask questions, and people who are actually doing this can respond back to you. In addition, I have my website. Most every video that I have on YouTube also has a corresponding blog post. So depending on whether you like to read or watch, as you're doing more research into this subject and trying to learn, you have your choice of video or simply reading it. And if you'd like to find out what the numbers look like for yourself, if you've learned all you wanted and you've got a few remaining questions that you want to talk about or see the numbers, there's a link to set up an appointment on my calendar. That's down in the description down below. Feel free to use that, set up a time where we can talk. And again, if you want to support this channel financially, there's a link to buymeacoff.ee down in the description. Any support is greatly appreciated. So with that, I'd like to thank you for your time and attention, and I'll see you in the next video.